when people say, hey, there's only 9 tech IPOs, your initial impression is, oh, wow, investors must have a massively high bar. Turns out it's really a supply issue.
Hello, everyone. Welcome back to another episode of the Data Minute Podcast. I'm your host, Peter Walker, Head of Insights at Carta. Today, I was joined by Dave Chen, the Head of Global Technology Investment Banking at Morgan Stanley. This is a pretty fascinating conversation, a bit of a departure from the normal talks that we do. We focused entirely on IPO readiness. What do founders need to consider 2, even 3 years before they IPO, which, by the way, Dave recommends that you engage with a banker probably around that timeline because there are many, many steps that you have to take to make sure your business is ready for the public markets. We, of course, discussed the recent turmoil in the public markets, ways to gauge public optimism about private companies, and the various ways that companies are prepping both their internal staff, their financial metrics, and their story to public market investors. Let's jump into the conversation now. Well, Dave, thank you so much for joining me today. Really appreciate you being here.
Great to be here. And, Peter, in my job, I do, as we were just talking, a lot of events myself. And, I do a lot of this kind of stuff, but I'm the one that's usually doing the interviewing. So really appreciate, you turn the tables on me.
Yes.
And perhaps, in the near future, I'm going to turn the tables and I'm going to have you at one of my events.
Absolutely. We'll do a home and home in that case.
Yeah.
Sounds fantastic. Before we jump into all things IPO, I think it'd be great for maybe the audience just to learn a little bit about yourself and your career path through Morgan Stanley.
Yeah, absolutely. Grew up in Midwest, Wisconsin and Minnesota.
Nice.
And then came out to California for college, Stanford, and my whole career, has been in tech, and then my family was all in tech. So dad, mom. And so when I went to college, I really wanted to differentiate. When I was a kid, you want to do something different.
Yep.
So I was pre-med and, got into medical school. But then at the same time, Yahoo had just gone public, maybe 3 years before I was going to graduate. Google was a super interesting company at the time. A lot of my classmates were going to work there. And then I just took a pass-fail course at the business school. It was I forget what it's called, Introduction to Entrepreneurship.
Okay.
And just one credit pass fail, you just sit there and you just roll legendary entrepreneur after legendary entrepreneur. Yeah. And it was very difficult not to get excited with the tech bug.
Slightly different than your medical courses.
Exactly. Yeah. So didn't know how to code. And so ended up finding my way to UBS in their tech group and did some super interesting transactions there. I was there for 3.5 years, and then I went over to Morgan Stanley in 2002, and I've been there ever since.
So to the topic of today's discussion, which is, of course, IPOs, IPO readiness, et cetera, I'm wondering if we could maybe take a step back and say, how have IPOs changed over the last 10 years? What are the biggest similarities or differences between an IPO today and an IPO in 2015 or so?
I think the one similarity, and one thing that's never going to change, is kind of what we just talked about, which is you take a founder, they, work so hard to build this amazing product, and then the product turns into a couple of customers, and then it turns into a company, and then they kind of bring you along with them. So then they hire bankers, lawyers, auditors, and just the whole journey of working with the founder. They're used to basically talking to customers and then basically helping them think about, okay, I know you're pitching your company from a customer perspective. Let me actually package your story for institutional investors, which is different.
Yep.
And then anticipating what the potential questions are going to be, and then taking them through the whole roadshow, and then basically, you're at the NASDAQ or an NYSE with them. It's just a culminating moment of satisfaction for a company, and then you're kind of there. So I think similarity is that's not going to change.
Yep.
From IPOs 10, 15 years ago to today. Similarity would also just be just the basic building blocks. So you write an S1, you create a presentation, you go on a roadshow, and things like that. I think what's changed would be, first would just be perhaps like the time at which you spend with a company and when it's actually going public. So like maybe 15, 20 years ago, the company would basically say, hey, let's actually bake off. We're getting ready. Let's do a bake off. And then in 6 months, let's go public.
Okay.
And so you're kind of meeting the companies in a relatively recent time period from the IPO.
And just for the audience, bake off meaning?
Bake off is just simply, this is a time in which they actually think about picking bankers.
Gotcha.
So yeah, it's
bake off between. It's funny.
It's not. Yeah, it's exactly. Yeah, that's right. It's a classic term.
You're on offer.
It's a jargon in the industry. Yeah.
Yep.
And now I think we're getting to know companies, this is relevant for the audience, right? We're getting to know companies like 2, 3, 4 years away from the IPO, just because there's so much that we can do to provide our wisdom for a company at an early stage and help them be a much, much better IPO if and when they want to go.
Yeah.
Second would just be probably the scale. The scale of companies going public today have really changed. Like when some of my first IPOs were like, literally the company had 75 million of trailing revenues, taking them public at like 300 or 400 million of market cap. And that was a good size IPO back then.
Right.
Much bigger today. I think just because like the size of the capital markets, the amount of liquidity out there, the deeper base of institutional investors that are investing in growth, much, much larger than it was like 15, 20 years ago. And as a result, I think you have companies that need to kind of get larger to attract a check size from these much larger pools of capital that will make a meaningful difference for them.
Do you think that there's still room for that small to middle market IPO, or is it really like the game has just shifted so much that you have to be of a certain scale in order to really approach the public markets?
That's a great question. I think it will depend on the type of market we're in. So if we're we actually kind of looked at the market. If you look at the last 20 years, and we kind of divided the types of environments that we've been in terms of like what's the climate in which you're actually going public. And it turns out like half the time over the last 20 years, we've been in a time period where we call kind of lean in, which is a market that's pretty conducive to a smaller company, right? And by smaller, I mean, like 150-ish million of top line, let's take a typical software company that is presumably growing, 40 or 50%. And it doesn't really have to be profitable. It can be actually investing for growth for like 8 quarters. And if you're in that kind of in climate, which is basically been half the time over the last 20 years, absolutely.
And so the other half would lean out or,
the other half would be a climate where kind of like where we just came from. Like 2022, certainly 23 was a little bit better, 24 a little bit better, but still these are markets characterized what we call kind of sober and clinical. Okay. So markets where investors are interested in investing in new companies, but also there's going to be a heavy eye toward diligence around the plan. And sure, they'll give you maybe some credit for your upside. Maybe you have some act 2 in your business that you're super excited about. It's like 1% of revenues today. And you're telling investors, hey, this is going to be 20, 30% in a few years. If you're in a sober and clinical market, that investor will be like, okay, I'll give you credit for like 5% of that.
Right.
And on top of that, I'm going to need, a little bit of profitability today, or you better show me, if you're not profitable, then you better show me some really strong unit economics.
Right.
So, and that tends to be a market where you're kind of like, 250 million plus in scale.
Yeah. And is it just that, that higher bar for going public, is that the main contributor to companies engaging with you all much, much earlier in the process and this timeline kind of being elongated? Or are there other reasons why IPO readiness is now a much bigger process?
there's one overarching reason, which is I think, investment banks like Morgan Stanley, we can actually add a lot of value to a company well beyond just like IPO readiness. We're obviously a huge, we're a big firm that actually buys a lot of software.
Right.
So we're a firm that actually runs a lot of events, and we connect, founders and CEOs together. And we can also then, one part of IPO readiness, to get into your question, really is around metrics.
Yeah.
And, I can remember a number of IPOs I've done where these are the ones that are more shotgun wedding type relationships, where you kind of just get parachuted in, and then the company is looking to go public, and then you're trying to ask them, okay, well, great. Well, I get that you have the basic income statement, but let's now understand kind of what are the non-GAAP metrics that really run your business and how you use to kind of measure success. And when you dive in, I remember one company, one situation where they said, you know what, that's a great question. That is the right metric. I don't know what the answer is.
Right.
And this was like 3 months before the IPO we were supposed to launch.
Yeah.
And so we had to go back to the drawing board, and, they bought, a copy of Tableau, and then basically created that metric by looking at historical data.
Right.
And then we ended up having to, like, they weren't able to go public in the time period that they wanted to. So the point being, work with Morgan Stanley to kind of come in much earlier so that we can give you a sense for, like, okay, based on your business, this is what investors are going to really be focused on.
Yeah.
Start tracking these 3 metrics now.
Yeah.
It's just one example for why we are starting to work with companies sooner.
Nice. And I think the number one question that we're speaking this week in, early April 2025, there's been all sorts of things happening in the public markets.
Some fun stuff. Yeah.
Yeah. It's been a fun week for everyone. Given that and the general idea about gauging market sentiment around going public, how do founders, what's the best way for founders to really understand their company's attractiveness to public market investors? Roadshow being one of the ways. Is that still the primary way that this happens? Or are there other ways that founders get that sort of information?
I think the roadshow is the primary method.
Yep.
But like, you wouldn't start the roadshow. If you start the roadshow, then you've pretty much committed to the path. And so that's kind of much later in the process. I think, to your question, I think the working with banks like ourselves much early on in the process. Right now, like, we've moved from a market where 20 years ago, 15 years ago, companies would exchange business cards with, all of their top institutional investors at the roadshow.
Yeah.
So there weren't a lot of like historical relationships between companies and investors. And today, what we recommend for companies, and this is really important, is like, if you're, 2-3 years out, this is a time to be building institutional relationships with when we launch a roadshow today, we shoot for the CEO and CFO having a personal, like, one-on-one relationship grounded in face-to-face interaction, maybe at least 2 face-to-face interactions with the top 20 fund managers, analysts, and portfolio managers that we would target, and to have all of that built out, before we even launch the deal.
And that's a different list of investors for every company, right? It's
absolutely.
Yeah.
It's
well, very specific to us.
Absolutely.
Right. Yeah.
And so my point is, like, if you to accomplish that requires a lot of relationship building.
Yep.
We need to kind of work on your story, and then we need to actually then take it to these investors in a variety of different formats. They could be investor conferences, they could be our own events, and of course they could be the classic non-deal roadshow where you're kind of taking the company to their offices.
Right.
And that all kind of starts 2 to 3 years ahead.
Right.
So that's really the best way, back to your original question on how to gauge market feedback on readiness.
And so then say you had gone through this process, you've done the 2.5 years of pre-work in this sense, like getting to know the right investors,
Right.
and you have a target date in mind, and then something happens in the macro and you say, well, we think it might be worthwhile delaying. Do those public market investors say, yep, we totally understand, we think you're making a smart decision, or do you have to re-engage those relationships as you go through?
So we wouldn't, we typically, I mean, we've done this, but we typically wouldn't, the goal, I think, is as a founder, you want to just build your business with sound fundamentals so that you can take your business kind of public in any market.
Yep.
And then work with a bank to then get you ready. And then basically the bank can give you the feedback on kind of what kind of market are we in? Are we in kind of lean out? Are we in kind of sober and clinical? Are we in lean in? And then based on that, you want to be ready to go public.
Mm-hmm.
And so then in general, like given macro volatility, we would work with a company and launch at the right time.
Yeah.
Doesn't happen a lot. Sometimes you'll see this, but it's rare if the idea of like launching a deal
Mm-hmm.
and then not completing it.
Right.
Yep. It's if you launch, then 99.9% chance you're gonna complete that transaction. Yeah.
Gotcha. And do you think, just looking at, say, the most recent year of transactions for you all, 2024,
yeah,
how would you rate that IPO market? Like, what are the things that you would take away or say, hey, founders can learn from what happened in 2024 for anyone who's considering 25 or even, the next couple years?
Yeah, I mean, 24 was certainly better than 23.
Sure.
Like, if you just to put things in context, like on average, we have maybe 30, 35 tech IPOs, if you look in the last 20, 25 years.
Mm-hmm.
And 2021 was like a very large number, like
right?
Well over 130. And then, 2024 was like 9. So 9 tech IPOs. We actually thought going into 24 that was going to be a much stronger year. Mm. So there were 9 tech IPOs. I think kind of takeaways would be it really wasn't a lot of times when people say, hey, there's only 9 tech IPOs, your initial impression is, oh wow, investors must have a massively high bar.
Right.
Only 9 tech IPOs.
Right.
Turns out it's actually, it's actually a little combination of both, but it's really a supply issue. Like there just weren't enough companies that were getting to the point where they had the predictability and visibility, and they were kind of willing to kind of test the IPO market. I think that was really driven by, I think a lot of these companies in 24, they were still recovering from some of the growth doldrums from 2022 and 2023. Those are pretty difficult years.
Definitely.
And so you have to, if you go public, you have to have a certain requisite level of top line growth at a certain scale with visibility. And so, I think we're still working off that dynamic.
Mm-hmm.
And I think we're set up much better going into 26.
Yeah.
So, and the other point is just the fact that the companies had other options. So, they typically, like, I don't know, 15 years ago, like you do Series A, B, C, D venture funding, and then it's like, okay, let's go public,
right?
And a lot of times those companies actually needed primary capital to fund them to break even.
Yep.
And they use the IPO markets. Today, I think the markets have just gotten much larger. We have significant pools of capital. A lot of the traditional money managers that invest in primary IPOs are now have massive sleeves to invest in private companies. And as a result, the private companies have a lot more options at their disposal to basically stay private for longer.
Yeah, that's the phenomenon of those late stage secondaries that we've seen kind of pop up. Do you think that is a lasting feature of the ecosystem, or is that more of a fad?
It's definitely lasting.
Okay.
Yeah, it's definitely lasting. Yeah.
And do you think that will then, because, I think the late stage secondary story has been a really fascinating one for a pretty small cohort of companies, if we're being honest. Like so much of the value has been, or the activity has been driven by, 5 to 8 names. Do you think that will expand to 10 to 20 to 50, or is it there's just going to be a lot of capital available to the best 5 to 8 names, depending on who those happen to be.
Yeah, I think it'll be, I think what you're referring to is like your classic plain vanilla preferred round with 1x liquidation pref from the crossover community. And yes, there's a cohort of really super high quality companies where there's a lot of money chasing those names.
Sure.
There's also the ability to then introduce a little bit of structure to these deals. And that's where we've seen the market really, really blow out. So you take investors, some of these are the same investors that invest in, I think, companies that you're referring to. But then some of these investors are different. They have a little bit more debt-like feel to them. They're kind of a little bit more downside focus with an eye toward upside. And if you add a little bit of structure, i.e., you can invest in the company in a structure that will convert, and it'll convert at a potential like actually a premium to where I go public. And then there's basically there's some downside protection features. So if you actually add a little bit of that to the story, then we're seeing significant demand for larger companies that want to stay private for 2 or 3 years. Maybe you want to return some capital back to your venture capital owner or your private equity owner. And you're seeing deals like in the $1 billion to $2 billion range because you're giving that really nice, attractive balance of growth and downside protection.
Why do you think that so many more investors are interested in that kind of deal than before? Is it just a natural growth of private markets and we were always kind of going to get here?
It's a natural growth. There's a scarcity of, supply in the IPO market. And so they've gone that way. The second one would be that, still like, I think these institutional managers, they're looking to basically, get more of a company. If they find a company they just love, a lot of times and we're looking to allocate at the IPO, we're going to try to be as fair as possible, and we're going to try to put the money where we think into long-term holders. And so sometimes like you can't give these institutions enough, and so like a lot of times they like to actually have already invested in the company, so they can kind of like dollar cost average their overall position. So that's a big strategy for lots of different fund managers, and that's also why they're coming into the private markets as well.
Gotcha. Does that mean, is there a significant difference then between the tech names that are in this range and perhaps gearing up for an IPO in a couple years, and then the non-tech names, or those follow pretty similar processes?
I think I'm referring to mostly the tech names. Though, the definition of tech these days, like we're, we do a lot of work with some amazing healthcare companies that are effectively tech businesses. We're doing a lot of work in the robotic space, which kind of touch aerospace and defense and industrials. And then, even one of the most super interesting sectors right now is the cross-section of financial institutions and tech and payments and fintech. So I think it applies, what I'm referring to is like probably software and internet, but I think it applies more broadly.
Across the stages, totally. So, okay, imagine, I'm a founder. I've raised pretty significant late stage capital in venture, and I'm thinking about potentially going public in 3 years. What are some of the areas of work that I should be thinking about in that, 2 to 3 years in advance of my IPO?
So I would start with the metrics piece. So like work with a banker, really understand your business and what really drives, like if you're a SaaS business, obviously like there's things like net retention. But like, hey, if you're a company that sells to small businesses versus enterprise, I might want to cut your metrics to actually make the lion's share of your business shine, whereas maybe you have another portion of your business that may actually have more churn. So it's like cutting the metrics like that and then starting to track those metrics to put the best light on your business for the portion of the business that matters the most, things like that.
Yep. Do you find that founders are already, when you come into a business and you're beginning those conversations, are founders usually cutting the data in the way that you would have expected, or are they doing something else and you're like, actually, the institutional perspective is this, and we probably need to adjust the way we're looking at those metrics?
I mean, by and large, we have value to add. Like so I think founders are definitely very informed today on it's easy to kind of look at prospectuses of companies that just went public that are kind of generally in their space, or companies that have the same business model, and then try to basically track the same metrics. But I like to say that we kind of come in with a holistic perspective, and we can definitely add value around that. The second one just would be obviously the management team, and where I've seen things go wrong is just the fact that the company will get to like maybe 6 months before the IPO, and then add the CFO.
Wow.
Okay. Or the other point is like the company goes public, and then turns out the head of sales wasn't the person that can really scale, and so the head of sales is swapped like very shortly after the IPO. That's not great either. So like stepping back and making sure you actually have the management team before the IPO that can really kind of take you to the next level for the next 3 to 5 years, I think takes a lot of work.
Does that also have implications for the board as well? Is that inclusive of the management team? Or
board, absolutely.
Okay.
Yeah. Designing your board takes a long time to get right, and filling each function and being holding yourself to a high bar on finding candidates and it's also just not like a lot of my clients will just focus on the optics of this person who is kind of a celebrity.
Sure.
And what I found is that might work sometimes, but like a lot of times my CEO and CFO clients, they actually prefer someone who, certainly is accomplished in his or her field, but actually has the time and actually might actually be close to the CEO and CFO to literally drive down the street, actually sit down with them just like this, and actually have real meaningful conversations around advice.
Gotcha.
But like little things like, for example, like if you're going to hire a CFO, what I've seen is like the CEO sometimes will have an amazing audit chair opportunity, and if you put in an audit chair and then you hire the CFO later, that's not great. You typically want to start, right? But I've seen that happen many times. Like, do you really want to start with the CFO first and then let, her or him basically choose the audit chair? So it's like little tactical things like that.
For sure. Yeah.
And then, then it would be just like more strategically, in terms of timing your IPO, there's kind of like predictability and visibility. And that is, there's a lot of different things happening in the market today. One of the things is a lot of our companies are changing their business model. So a lot of them come from they offer a subscription and it's on-prem, and now they're going from on-prem to pure SaaS.
Yep.
Or some of our companies that maybe started pure SaaS, given the changes in the market with cloud and AI, now they're trying to go to more of a consumption model. And so I think from a preparation perspective, you don't want to be trying these out in the public markets. Right. You want those business models to be kind of a well-oiled machine, so that you can actually predict your numbers as a publicly traded company. So that's an important thing to get right well ahead.
For sure. Are there any other sort of tactical or like operational changes, maybe either in like the finance teams or anything that you see as, that it's kind of a maturing aspect of the business, you need to get this part of the org right, et cetera?
Like getting more tactical, the financial model. So you'll have a VP of finance, typically a CFO, and most companies, when we are working with them, even like 2 years before the IPO, a lot of times they have one plan. And we're going to then be talking to them about, well, okay, let's talk about a beat and raise plan. So let's talk about a plan that you absolutely can't miss. Then now show me the plan that, you know what, maybe you might show your board and likely you're going to hit, but there might be a little bit of, potential areas of, where you might miss. And then show me the stretch plan.
Mm-hmm.
And so it's important to actually have a pretty good handle on operating like a public company and having a plan and then literally like having, hey, I'm going to hit this number next quarter. And then actually, why don't you actually prep ahead of time? Actually pretend you're doing an earnings call.
Right.
Because that creates the discipline across the entire organization to get ready for the call and to actually present the best, the company in the best light,
right,
both from qualitative and financial perspective.
And it's probably a completely new muscle for the management teams and founders to have to sort of think through, okay, how is this going to impact the view that the street has of me?
Yeah.
If I need to hit these baselines, et cetera, et cetera.
Yeah.
Yeah.
Good legal counsel is obviously important.
Sure.
To have an outside counsel that has experience taking companies public. Other kind of small little things that I have found, like I think this is pretty relevant for your audience. Like if you're a company and you want to buy a company to grow,
mm-hmm.
like, and maybe an acqui-hire, right? $50 million acquisition, $100 million acquisition, maybe using stock, maybe using a little bit of cash on the balance sheet.
Sure.
There are tests that the auditors will use to determine materiality. And it's not just like revenues, percent of revenues of the overall. There's a balance sheet test as well. And based on your assets versus theirs, you can be surprised and caught off guard. You might be thinking you're buying a small company, it's a small percentage of revenues.
Right.
But if you trip that materiality test, then it's required that you actually pro forma the financials of the two together. And if you're going to try to do that, right, I have one story where, we were taking company public and, literally at the org meeting, we, the company said, hey, we just bought a small company, no problem. And then somebody raised their hand and said, hey, does that company, did you guys do the materiality test? And then they said, okay, well, we need to look into that. Turns out the balance sheet piece tripped materiality. And so then the company actually had to delay the IPO for 6 months.
Wow.
Yeah. So
problem.
That's just like one tactical piece of advice for, companies that are looking to buy other companies close to the IPO.
Yeah.
Yeah.
Any other, speaking of, I love that example. Any other, we'll call them near fatal or very serious mistakes that you see companies make as they go through this, prep to roadshow to IPO process?
So that would be a big one. I would say the other one would just be the idea of it almost goes back to your original question on just preparing for the macro, preparing your company to go public, but then being subject to the macro environment. And so the lesson is don't become just so focused on the process itself. And so what happens is you write the S1, you do 50 revs of the PowerPoint to get that right. You may have hired a outside production company. Nowadays the roadshow is now like a movie production.
Right. Yeah.
So you've done that. Okay. Yeah. And you've had, 9 months of drafting sessions and meetings with bankers. And it can just be everyone wants it done.
Yep.
And everyone wants to launch. And so what I found is, I guess one near fatal potential mistake is companies just because they just want to get it done, despite, a little bit of some choppy markets, they just basically launch. And so
when they should have, perhaps
they absolutely should have waited.
Yeah.
And so that's definitely one thing. Just don't let the process control you. Work with the bankers and lawyers to get ready to go public, but be very clinical about deciding when to launch.
Gotcha.
Yeah.
And is that when to launch from the moment that you make that decision is, I'm assuming that can be put off indefinitely, but if you're already very far down the road, I think it's probably a more difficult decision. So like when in the process is it really a go or no go where you can say, look, we thought we were going out, at the end of this month, but we just don't think that the macro is going to be with it? Or is it as close to a week before that you could make that decision?
Yeah, the point of no return is what you're asking. Yeah, the point of no return really is when you flip the company, the S1 to be public.
Mm-hmm. Okay.
And so you typically the typical company will file the S1 confidentially with the SEC.
Yep.
And then work through the changes with the SEC until a time when basically you're pretty much done with that process. Then you will actually then flip the S1 public. And then by and large, when that happens, most companies are actually going public, a few weeks to a month after that.
Okay.
So that's kind of the point of no return.
Yeah.
Because if you don't do that, then you can basically stay silent and just live to fight another day. Yeah.
Right. That makes sense.
Yeah.
I guess there's two sort of final topics before we can and I like to wrap up with a couple of final questions as well. But the first one is around valuation. So one of, if not the biggest question in private markets right now, which is how are these companies being valued? And do these models make sense? And then, of course, how do they relate to the public company valuations that we've already seen? So how do you go about deciding on valuing a company during the IPO process?
Okay. That's a pretty broad question.
Agree. Yeah. This could be another hour.
It's hard to do that. Hard to do this with specificity. Sure. But I'll try. Basically, company goes public. The first answer to your question is actually investors actually value the company, and so bankers, we're going to try to give you our best shot, and we're going to actually give you a sense for how we would lead investors to then apply a multiple to your company and then invest in the IPO. In terms of how we do that, obviously it's comparable company analysis, and we're going to pick typically we'll pick a group of companies that, if it's a company that literally where we actually have 3, 4, 5 companies that actually operate in your specific market segment, then it's for better or worse, we're going to focus on that category because investors are going to gravitate to that. And if we have the benefit of the fact that those 3 or 4 or 5 companies are actually trading, let's take a median multiple that is actually quite attractive. I'll just make up a number. Let's say, they're trading at 10 times revenues.
Yep.
Okay. Then, we'll be basically saying, hey, you know what? We look like these companies, and we might not be quite as profitable, but boy, we're growing faster. And let me point you to this technology area of differentiation that suggests that we actually should be trading higher than 10x.
Yep.
Then the second group would be, we'll focus on, a group of comparables that, perhaps might actually have a similar business model. They might not actually hit the actual end market of your company, but let's talk about similar business models. And then also third would be, let's talk about a group of companies that have similar financial characteristics.
Okay.
So, it might be a different business model. So we'll triangulate with direct comps, business model comps, and financial characteristic comps to advocate for value around your company from a comparable analysis perspective.
What's a good, you said 3, 4, maybe 5 on the direct comps. I'm assuming that pool is typically pretty small in the single digits of companies.
That pool is typically small, and a lot of times it's zero.
Right. Yeah.
There's a lot of times, at Morgan Stanley, we have the benefit of working with some amazing disruptive companies that are N of one and are evangelizing a space and have proven it out. And so in that situation, there's going to be zero in that first category. So then you're really resorting to business model and financial characteristics of comps.
And what's a good looking or number for a pool of comps in those? Are we talking like dozens of companies in the business model comp?
That's too many. Yeah. I think,
okay.
yeah, I think we'd like to zero in on just a handful in either group.
Right.
Yeah.
So we're trying to get as specific as possible.
We're trying to get as specific as possible.
Okay.
Yeah.
Yeah.
And then, so that's comps. And then typically you will look at some sort of out year analysis. So, a lot of times, these are emerging companies. They're not at their steady state business model yet, which will typically come, 5 to 7 years out.
Yep.
And so let's say, hey, let's imagine a point at which you are steady state. Let's look at what multiples, we would apply to a company that looks like you from a steady state perspective.
Right.
Let's apply that multiple in the future and then discount that back. And so we do that to try to give the company credit for where the company could become over time. And so we kind of come at it from comps, which is more right now, here and right now.
Sure. Yep.
And then kind of more of a discounted equity value or DCF based approach to give more credit for the future.
And then, and I'm assuming during the roadshow, you kind of get a sense, or maybe even pre that, how other investors are viewing this company, whether it's kind of more aspirational or are they viewing it a direct comp to another business, et cetera, et cetera.
Oh yeah. 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 We get feedback pretty quickly.
Yeah.
As soon as we launch the roadshow, then our sales force, our capital markets teams are having conversations with investors and getting feedback on what's their valuation framework.
Yeah.
And then, there's a price range that we put, in the initial prospectus. And then, certainly throughout the roadshow, based on feedback, we will either stick with that price range or we can vary based on market demand. Yeah.
Right. Cool. And I guess, so you've made the decision, you've had the roadshow, you kind of feeling out, what is that last couple days like, man, before you go public? Are there any big decisions that are left to make, or is it really just trying to make sure operations are streamlined and you're good to go?
I mean, those are some of the most exciting, most memorable days of my career.
Yeah.
So it's the idea of, you've delivered the story like 50 times now.
Right.
And now you have a decision to make. Here's the typical, you have a decision to make. Hey, you're well oversubscribed. And now you have a decision to make on, do you want to price above the range and how many dollars above the range? Or potentially, do you actually want to raise the range and price, at the top end or even above that range? And it goes into the calculus for an investor and an entrepreneur on, hey, look, how much capital do I really need? Do I actually want to, a lot of times they're actually giving back some capital to existing investors, so like primary versus secondary. And then also like each, I always tell companies like, hey, this is your IPO. Like this is, you tell me what you're trying to solve. What are your objectives? So sometimes actually companies are super focused on not leaving a lot, and so kind of pricing this to where we think close to fair value is.
Right. Yep.
And then other companies, they want a little bit more leeway and probability that the stock actually trades up nicely, because who knows what the market's going to be when you trade on day one.
Yep.
You actually make those decisions before.
Absolutely.
And so this is kind of your IPO. And so a lot of, to your question, the last 2 days is that calculus around, price, size, and your philosophy around how you think you want it to trade.
Right.
And then we take all that in, it's your IPO, your hands on the steering wheel, and then we'll give you advice on, the last mile.
Are there any considerations that people have vis-a-vis like press in those moments? Because of the IPOs that I can remember in the last 18 months or so, there's sometimes those stories that leak out that say, oh, someone is trading above their range, or this is oversubscribed or whatever. Does that come into the calculations, or is it really like we leave that to one side? It's not important.
Yeah, the more and more of the last, when your first question is what's changed in the IPO process, I should have mentioned press. So press has definitely been more of an equation, part of the equation in IPOs. But in terms of like the answer question, yeah, I mean, institutional investors are not listening to what they're reading about from a press perspective per se. Yeah. It does create a little bit of noise, both positive and negative. But we're staying focused on, the company, what we see fundamentally in terms of demand in the book to make those fundamental decisions. Yeah,
definitely. Dave, this has been awesome. Any final words of advice for entrepreneurs or founders who are thinking about tapping the IPO markets, either this year in 25 or perhaps, in the next couple?
Yeah, sure. Absolutely. I would just say, like there's a lot of stuff happening in the market right now, but like I would just like build a very sustainable, durable business. And back to our earlier topic, it's, the best in class companies are getting prepped for the IPO. I'm going to use it 3 years ahead.
Yep. And
so it's not one of these situations where like you kind of focus and then you lift your head up, let's do a bake off and let's go public. Actually, the best way to do it is just, pick somebody, work with them, 3 years ahead of time, and we can kind of help you with metrics.
You're probably too humble to say it, but I'm sure any founder or entrepreneur would be lucky to have you and the Morgan Stanley team behind them as they do this process. But
yeah.
Thanks so much for coming in, man. This has been awesome.
Hey, thanks so much, Peter.